Well, let me now bring on board Timothy Moore, Chief Asia Pacific Strategist at Goldman Sachs. Timothy, good morning. Thank you for joining us. Let me kickstart the discussion with your thoughts on India. At the current juncture, what are your views on India? And after the recent correction, are you still of the view that Indian markets, the Nifty, will touch 7,000 in this calendar year?
Yes, we do. We think that's a reasonable target, and we can get there without a lot of sort of mental gymnastics. It's pretty straightforward. We think that earnings growth will begin to pick up in India, both for this year and for next, as the economy begins to recover momentum, which is a key underlying assumption and something which I'm sure we'll discuss a bit further. The valuations for India right now, we think, are very justifiable. They're 13, 14 times forward earnings, depending upon sort of which day and exactly how you're measuring the earnings. But those sorts of valuations are reasonable. There's a variety of approaches that we can use to justify that sort of level. So from here to get to that 7,000 Nifty target would basically entail riding the underlying earnings slope and maybe having a tad of valuation expansion from here, but nothing that stretches the imagination unduly. So we think that's a credible sense of direction and magnitude for the Indian market to get to, if indeed we get the kind of fundamental developments that we are looking for.
Timothy, how do you read flow signs in India? On one hand, we have foreign funds holding at almost peak. Domestic institutions, though, have been sellers, while retail investors have been completely amiss.
Overall, we think we're still in a phase where foreign investors are realizing that on a longer-term basis, India does look as though it falls into the category of a destination where one needs to have more exposure given the longer-term growth opportunities, the size of the market, the longer-term core emerging market investment case, which many of us are familiar with. Now, the subtler and nearer-term issues, of course, revolve around the cyclical uncertainties, and that has been something which has been worrisome rather to domestic Indian investors, and for a host of reasons which we don't have time to go into, that has curtailed some of the very strong domestic flows which we had seen in previous years and has had those taper off. So I think that what will, from a flow standpoint, what we would like to see, and in fact we do anticipate seeing, is some sort of a return of the domestic investor to the Indian equity market. Our sense is that the likelihood for that happening will be greatly increased as we see signs of the cycle, the macroeconomic cycle, beginning to improve, and also some signs of improvement with regard to policy. And of course, that brings us to the topical subject of the upcoming budget announcement.
So what themes are you playing in India at the current juncture?
Broadly speaking, and very much consonant with what I just said, really the issue we're looking at is a recovery in economic momentum. All the work we've done in terms of analyzing the Indian equity market suggests that, of course, there are a lot of shorter-term factors that can influence the gyrations of the market. But if you look at the correlations with various macro factors over longer periods of time, it's pretty clear that India trades its domestic growth cycle. That is something which shows up very, very clearly in the data through a number of different cycles, and we don't see any reason why that shouldn't continue to hold. It makes all sorts of logical and economic sense, and it's something which we expect. So the key point here is that we need to see a convincing turn in the industrial production cycle. If you look at a chart of it, we've come down, we've had a significant deceleration in India's economy, as I'm sure all aware. We've had some tantalizing signs of a turn in the IP cycle, but it hasn't really taken root yet. And in fact, because the government has actually done a better job than we in consensus have expected with regard to the fiscal deficit, that's actually put a bit more of a constraint on growth in the near term. So fiscal deficit, which we thought might have been in the high fives, looks like it's coming out this year at about 5.3%. The expectations for the budget is that it will come in about 4.8%. That's good from a healing of the financial imbalances and getting the government's balance sheet back in order and its finances back in order. But in the short term, it detracts from growth, obviously. So it's really a trade-off in terms of necessary fundamental financial repair, which has lots of positive ripple effects, versus the near-term impact on growth. And that's sort of the juncture that we currently find ourselves at right now. Our expectation is that the economy will indeed begin to gather some traction as we look into the next fiscal year. And we're looking for recovery in GDP growth from the low fives this fiscal year to about 6.7% next. Might be a tad of risk to that number, but certainly mid-sixes is a very credible estimate. If indeed we get that, and that suggests that the cycle does begin to turn up, then that's good for earnings, it's good for confidence, it probably engenders flows, and that gets you the kind of positive equity story that we think is likely to occur as this year plays out.
Right. Any risks you see to the India story then, Timothy?
Of course, there are many. It's India, right? So there are lots of things which can go awry, and that would include on the political side or the policy side, lack of progress in terms of implementing some of the necessary changes and reforms. We're very much expecting some progress on the goods and services tax, for example. There's some other reforms with regard to subsidies that we'd like to see take place, perhaps in the energy space and so forth. So these are issues which invariably proceed slowly given the political process. And they're ones that we're hopeful we'll see some incremental progress on, but of course there are things which can go amiss. Also, we're expecting the RBI to gradually reduce rates as inflation comes down, but if inflation proves to be stickier and rates continue to be higher for longer, then that obviously would be an impediment to a growth recovery. And then, of course, there's the global environment overall, to which India is also sensitive, although less so than some other Asian economies, and that's something which, as I mentioned earlier, we're looking to improve, but if there are risks to that, then that obviously would weigh on the India recovery story. So there are a lot of intertwined factors here. Our base case is, as I've described, we're looking for the economy both globally and in India to begin to recover. That should drive a recovery in earnings growth. That in turn should impel a better investment mind frame. The animal spirit should get a little bit happier, and all that could bring us toward our nifty 7,000 target.
So, Timothy, can recent reforms and efforts to overcome structural issues by India boost growth from present 5.5% to 6%?
Yes, well, if I just to repeat that to make sure that I'm phrasing the question in the way I understand it, the current range of growth right now is 5 to 6%, which is very much at the low end of the last sort of decade's achieved levels. India has a much higher structural growth potential. Currently, we reckon it's somewhere in the mid 7%. Optimists would place India as having potential to grow 8 to 9%, but we think in order for that to happen, there certainly is the potential energy for that to happen, but in order for that to manifest, we would need a lot of structural reform, so-called supply-side reforms, that could unleash some more of that energy. So our focus very much in terms of seeing India's growth rate recover, not just from a cyclical standpoint, but raising its structural trend potential, would revolve around those sorts of structural reforms. We think there is great possibility of that happening, but it will take reform and political will, which sometimes has been lacking.